What's going on, everybody? It's Justin with Justin on Money. Today, we're going to talk about one of the most misunderstood topics in finance. It's been a while since I've posted, but I thought I'd come back and bring up the dollar debate, the dollar's collapsing debate. The world is abandoning the dollar. A lot of what I'm gonna talk about today is surrounded around this video, and specifically one of the clips I want to show you guys, or part sections of it. Um, Talking about the Treasury market, things like this. Um, but I want to first off by saying that there are real long term issues, right? The debt, deficits, inflation, geopolitical fragmentation, of course, and a lot of fiscal deterioration, and those are real. Those are real. But today, I want to explain something much deeper and try to connect this all up. Um, because I think there's a lot of misunderstanding why the dollar remains dominant. And I think people think reserve currency status is mainly about politics, or being a patriot or military power, or just simply trust. But the real answer is much more structural. The dollar remains dominant because the world is already deeply wired to into the dollar infrastructure. And, you know, I think it's important to understand the global financial system. We all can understand it. And I think it also allows us to make better decisions if we truly understand the nature of the beast. So I want to build this from the ground up. There'll be a couple parts, not just a couple, many parts. But part one, okay, I think is important to start out with, okay? And that is that the dollar is not just a currency. And this is the first major concept we need to address. Most people think the dollar is physical cash, Federal Reserve notes, or Treasury bonds, but the real dollar system is much larger than that. The dollar system is payment systems, settlement systems. It's repo markets, FX swap markets, dealer balance sheets, treasury collateral. I mean, the list goes on. Derivatives infrastructure, right? And many global liquidity networks. So the dollar is not merely a currency. It is really the operating system of global finance. And that's a really important distinction because the world runs on dollars. Okay, and this is part two. When we talk about global trade, mostly dollars. When we talk about oil, commodities, mostly dollars. Um, Shipping financing, cross border lending. I mean, uh, international bank funding, heavily dollar based. And here's the important part. Even when transactions do not involve the United States directly, they often still involve dollars somewhere inside the chain. And that's how deeply embedded the system really has become. So, um, I want to talk about why the payment system matters. We hear about the payment system, right? This is the hidden aspect, and it was really kind of one of the most aha moments for me, um, when when this kind of came to consciousness. So, um, most people never think about, or I never thought about, FedWire. You know, I heard about FedWire, but just kind of whatever. Uh, Chips, Swift, these large value payment systems, or settlement infrastructure, messaging systems, right? Um, it- but this is where the real monetary system lives. Um, the OCC literally describes payment systems as a critical components of the nation's financial infrastructure. That's a that's a pretty intense statement. Um, but why? Um, because modern finance is fundamentally balance sheet settlement. Um, not big large bags of cash moving around. Banks owe banks. Institutions owe institutions. Trades need settlement. Collateral also needs movement. And of course, liquidity needs transmission. And payment systems are the infrastructure that make all of that possible. And chips is one of the most important systems on Earth. And I don't really hear much talk about this outside of, um, you know, uh, maybe there's been a couple videos that have talked about this stuff, but really the only ones that are talking about it are the ones that really understand the system. And chips is the clearinghouse interbank payment system. Payment system. And this is one of the core arteries of the global dollar system. And according to the clearinghouse, and all this is public, 95% of chip payments either begin or end outside of the United States. Think about that for a second. That is massive. Think about what that means. The dollar system is not merely America's domestic banking system, it is global financial infrastructure. And chips processes approximately $1.79 trillion per day. Per day. That is not retail finance. That is, not mean speculation either. That is sovereign flows, interbank funding, cross-border settlement. I mean, FX transactions, corporate, corporate treasury operations, right? And a lot of liquidity management. This is the real system underneath the world economy, and it's something that's overlooked a lot most of the time. The dollar is really a network, though, and it's a really deep insight that we need to pay attention to. The dollar is not dominant simply because America says so. It's dominant because the entire global financial architecture has been built around it. Banks are connected to it. Corporations fund through it. Collateral chains rely heavy on it, right? So, and FX markets hedge through it as well. This is a network infrastructure. And replacing a reserve currency is not simply using another currency, it means replacing liquidity infrastructure, it means collateral infrastructure, replacing payments, legal infrastructure. I mean, the list goes on, and that is extraordinarily difficult. And this is why foreigners still buy treasuries, okay? Because we need to connect this up to the treasury market. People often say, if the world is abandoning the dollar, why are foreigners still buying treasuries, right? And that takes me to this video, which I'm about to share with you right now, okay? Um, Treasuries are not just investments, they are collateral, they are liquidity instruments, repo assets, balance sheet tools, reserve assets, and extremely popular funding instruments. The treasury market is deeply integrated into the global dollar funding system. And this is why foreign institutions still heavily participate in U.S. funding markets. Even when they diversify reserves, they still often need access to dollar collateral and dollar liquidity systems. And this is where FX swaps come in. And we get to really one of the most, I think, misunderstood parts of the system. People assume that if foreigners reduce dollar exposure, they must sell treasuries. But that's often not true. Okay. foreign investors can keep treasuries, keep dollar collateral exposure, and continue using U.S. funding markets while hedging dollar currency exposure. And that distinction is huge. And this is what this video is about. And I'm going to play this for you really quick. So let's go into it. Now, he's going to be asking a question. There's a guy by the name of Charles, I think, that is going to ask Mr. Shin a really, really important question. Very good question. So here we go.
Few weeks, Yun, where we've had.
Let me get to it.
So if you are welcome. So fine. So let's open the floor for the round. And okay. So yeah.
So if I look in the last few weeks, Yun, where we've had all these stories about how we don't trust investing in the U.S. anymore and foreign investors are trying to get out, but we've had this seeming paradox where Treasury yields didn't actually go up all that much, almost not at all, but the dollar depreciates a lot. One interpretation out there would be very consistent with your story is we had all these foreign investors holding these U.S. Treasuries that all of a sudden say, I need to hedge these. And as I'm trying to have a big increase in hedging, that pushed down the dollar exchange rate. Even though the Treasuries are fine, I don't want to sell the Treasuries, so I need to hedge. So that would fit very nicely your story, because we have seen an increase in hedging activity, or at least in FX swaps, as far as I can understand. The one thing that doesn't quite fit is that insofar as we're buying all of these FX swaps, I would expect that the banks providing them would now have to generate all these FX swaps, and I would expect to have seen an increase in cross-currency basis. A little bit more CIP deviation, because some guy has to be providing all these swaps. And that we haven't quite seen in the last few weeks. In other words, and more generally, but I think the last few weeks is part of the more interesting is, should I expect to see also another indicator here, which is this cross-currency basis moving with the amount of hedge? Or in other words, can you tell us a little bit about the supply of the FX swaps and the cost of supplying these FX swaps and how we can use the price of those?
So for those of you who don't know what the FX swap basis is, think of it like this. You know, when you do the what Ricardo is saying is, when we look at this initial diagram of how an FX swap works, I said that the forward rate is going to play a very important role. Now, the difference between the swap rate, so the spot rate and the forward rate, also embodies an implied interest rate, between these two currencies. And the FX swap basis is when the interest rate that's implied by the forward rate diverges from the interest rate that's actually prevailing in the market. So somehow you can make an arbitrage profit by looking at that difference and going long one and going short the other. Typically, the dollar interest rate in the forward exchange rate is higher than the dollar interest rate that's prevailing in the financial markets. So there's a kind of dollar shortage that's embedded in the FX swap market. That's because everyone wants the dollar. Japanese insurers, Dutch pension funds, they all want the dollar, and so there is an inherent excess demand for the dollar in the FX swap market. And what Ricardo is pointing out is that that didn't really seem to play out very much in the recent few weeks. Well, I think the answer is the demand, at least a short-term demand, was actually much diminished. And remember what's happening when you have an ex-post hedging operation. You're actually acquiring dollars. So remember this sequence here. So I get into a swap, but then I sell the dollars in the spot market. So there's an excess supply of dollars, right? So that's driving the spot exchange rate down, And there's actually, for a brief period, the swap basis went the other way. It actually reversed, right? So I think that's a very telltale sign that these things do move with financial markets. I see that Sushal's here actually, and maybe we can also. Actually, he was here briefly. I mean, strategic asset allocation is typically.
So, and I won't go on in this video, but it's a really, really good video. There's a lot of good information in it. It's an hour and a half long, but it is fantastic. And I love the BIS. They've got great data, and they are deeply ingrained in the system. Now, this takes me to the statement of that the foreign demand for treasuries is not the same as demand for dollars. And I think this is one of the just incredible insights, and it blew me away once I understood this. So imagine a Japanese insurance company, okay? Their liabilities are in yen, but Japanese bonds yield very little, clearly. So they buy U.S. treasuries. Why? Why do they buy U.S. treasuries? Because treasuries are deep, liquid, relatively safe, and globally accepted collateral. But there's a problem. They own now dollar-denominated assets. So if the dollar weakens against the yen, they can lose money in domestic currency terms. So instead of selling treasuries, they often hedge the currency exposure separately. And that hedge usually happens through FX swaps. So what is an FX swap? An FX swap is basically a temporary exchange of currencies. Think of it as synthetic dollar funding, okay? The institution obtains dollars, exchanges currencies, but agrees to reverse that transaction later. This allows them to keep the treasury while reducing currency exposure. And this explains something incredibly important. The dollar can weaken without foreigners dumping treasuries, because treasury demand and dollar exposure are not the same thing. And he also talks about this hidden dollar shortage in the video. And it gets really interesting here because the global system often has structural demand for dollar funding, not physical paper dollars. Balance sheet dollars, okay, synthetic dollar liquidity. And this creates something called the cross-currency basis, which he mentioned in this, and Ricardo is the guy's name, not Charles. Mentioned these deviations, okay? In theory, currency markets should price perfectly through something called covered interest parity. But after 2008, dealer banks became extremely capital constrained, leverage constrained and balance sheet constrained, basically. And because of that, global demand for dollar funding often exceeds dealer balance sheet capacity. And that's what the basis spread is really measuring, okay? And there's a lot of great videos about it out there. But so the real heart of the system, okay? Now ask yourself this. If everyone wants dollar funding, dollar hedges, and dollar liquidity, who stands on the other side? And the answer is dealer banks. Dealers are, I think, another one of those very overlooked parts of the system. And dealer balance sheets are the real transmission mechanisms of modern finance, not just the Federal Reserve. Dealer banks intermediate FX swaps, repo funding, collateral transformation, liquidity flows, and settlement obligations. And that is the real plumbing underneath global finance. So brings us to a pretty important question, which is why the system strains during crisis. During crises like 2008, March 2020, in the European sovereign crisis, everyone suddenly wants dollars, collateral, liquidity, and safe assets. Um, Demand for dollar funding explodes, but dealer balance sheets become constrained. And that's when FX swap pricing starts to blow out. These basis spreads widen and the system strains. And this is why the Federal Reserve had to open global dollar swap lines, because the world still desperately needed dollar liquidity infrastructure. And that really tells you something incredibly important. Now, this does not mean that the dollar is invincible forever. We want to stay balanced here and intelligent. This does not mean America has no problems. Deficits don't matter, or inflation cannot happen, of course. Or the dollar, lasts forever unchanged, right? It would be kind of ridiculous. All monetary systems evolve over time, right? But people massively underestimate the inertia of financial infrastructure. And they also underestimate the absence of a true replacement system right now, which poses the question, what would replace it? Okay. What replaces the dollar system today? The euro? Europe still lacks unified fiscal integration, sovereign debt, and complete capital market integration. China still has capital controls, lots of restricted convertibility as well, and opaque financial structures. And again, I gotta mention gold, right? Gold is not not a global settlement network. Okay, it is an asset, right? It is an asset. But what about crypto? Very interesting technology, but nowhere near replacing the institutional infrastructure of global banking. And this is why the dollar remains dominant. Of course, it's not perfect, but because the network around it remains the deepest and most liquid on Earth. And I think the biggest takeaway, bringing all this together, the dollar system is not just paper money, politics, or central banking. It is liquidity infrastructure. It is collateral infrastructure, settlement infrastructure, and of course, payment infrastructure. Chips alone, like I said, processes 1.79 trillion a day, with most of those flows connected to international activity. And that tells you something profound. The dollar system is deeply embedded into the operational structure of global finance. And systems this large do not disappear overnight. They persist because the world economy is already structurally connected to them. And that's the institutional argument. So, and honestly, it's a part that nobody really ever sees. So I appreciate it. If you enjoyed this video, subscribe, like, share, comment. I'm going to continue to try to break this stuff down. Repo markets, Eurodollars, Treasury collateral, these things that have been of great interest to me over the past several years. And things just, when you can understand a system that is already scary, already hard to understand, it helps with the with some of the headlines that can um, make you think that the world is coming to an end. So, anyways, I appreciate your time, and like, subscribe if you like the video, and I will see you guys next time.